Good afternoon, ladies. We're now looking at the last presentation to do with CC12. So that was the financial markets and monetary policy booklet, and the final section, which is a relatively short one, is the regulation of the banking system, which we sort of touched on a wee bit in previous presentations, but I thought it was worth just sort of reiterating this and treating it as a separate item, essentially. So we talked about the importance of regulating the banking system, and that's really come out since 2007-2008, when we clearly had what could only be described as a pretty dire financial crisis. So taking a look at the areas that you'll need to be aware of as far as the regulation of the banking system is concerned. First point is that there are a number of regulatory bodies now within the financial system of the UK. Quite significant that the Bank of England seems to be the controller of a lot of that regulation, in a sense, in that we've got the Prudential Regulation Authority, the Financial Policy Committee, and also the Financial Conduct Authority, which are all designed to try to make sure that banks are behaving in a correct way, that they're not actually trying to stitch consumers up, for want of a better term, and that if there are any irregularities of any description, any mis-selling or whatever, then there are now things in place to try to reduce the impact of that and essentially stop it, I suppose. What else do we need to be aware of? We might need to understand why a bank might fail, what some of the risks might be involved in long-term and lending and borrowing in the short term. And obviously it's when you get those out of kilter, if you like. If you're lending long-term, borrowing short-term, then obviously that can be a bit of an issue if things start to change, okay? Other things that banks will do is, and in this case, the Bank of England might, or a regulatory body might insist on certain levels of liquidity or capital ratios to demonstrate that the financial institution is stable. And should there be a situation where lots of people decided or wanted to try to withdraw their funds from a particular institution, that they have the wherewithal to be able to do that, which obviously is going to add to the stability of the overall system. We're going to look at, or you need to understand what the principle of moral hazard is, which we'll look at in a little bit more detail in a minute. And also this principle of systemic risk, which we keep talking about, and some of the impacts that might occur should financial markets fall over, should they systematically fail, and what impact that would have on the real economy, which obviously would be significant. It mentions here again that you need to understand what you don't need an in-depth of PRA, FPC, and the FCA, but you should appreciate the roles that they try to perform in order to maintain some sort of stability in the financial system. So that's the whole sort of rationale behind the regulatory bodies that have been introduced to try to control and try to manage and try to provide some stability for the financial system. Okay, let's move on then. And again, you're not going to need to you won't be asked to calculate liquidity and capital ratios, but you need to be aware of what they are. So some key terms for you to do some research on. There's quite a nice example tutor to you presentation that you can take a look at, which is a pretty good summary of the key issues that and the types of regulation that are now in place, really all based on the financial crisis, or all sort of kicked off by the issues that kicked off in the financial crisis, and the fact that banks were effectively not behaving in a way that they maybe should. They were taking greater risks than they should, and as a result of that caused significant problems within certain markets. Okay. So, reasons for regulation then. Clearly, there are a number, and these are listed, and there are some examples given on page 38 in your booklet. Asymmetric information, we've talked about that before, haven't we? We talked about the market for lemons and various other options, but where there's a possibility that a consumer might be being exploited, or there might be high cost and low quality products where essentially the reason that maybe people are not getting exactly what they were hoping for, or maybe aren't getting the value that they were expecting, is down to asymmetric information. And to some degree, the reason for regulation is an attempt to avoid market failures, or to ameliorate the issue around market failure. Negative externalities is the next one, so avoiding banks engaging in too risky activities which might lead to banking failure, which obviously then would impact and cause costs on third parties. In the case of the banks being bailed out, clearly in that case the negative externality was very much on the taxpayer, because some of us still own parts of Lloyds Bank and various others because of that whole process. Another reason for the regulation is the avoidance of systemic risks, and clearly one of the issues is that if we had a collapse within the financial sector, that's going to impose some significant costs across the whole economy, and so clearly it's not in anybody's interest for us to see the banking system fail, and as a result of that clearly is another reason for regulation, making sure that almost there's a fail-safe in place to make sure that should things start to go wrong, then there are warning signs, and actually in this case checks and balances in place to stop that from causing major issues. We also need to bear in mind something known as moral hazard, okay, and that's fundamentally where if you think about this principle, if you know in the background that in your heart, so let's say the banking system knew that even if they really messed up, they weren't really ever going to just be left to fall and falter, because the cost of that, the Bank of England and the government wasn't willing to deal with the cost of that, and so as a result of that, it's almost, well, if things go wrong, well, we know somebody's going to bail us out. So to some degree, rather than institutions feeling that they can get away with that, or that, oh, it's all right, somebody will help us out, this is very much trying to stop that mentality, okay, to avoid that principle of moral hazard. Different ways in which regulatory bodies and the different regulatory bodies that are included, and the sorts of things that they can do. Well, they can clearly impose rules and fines. Any of these regulatory bodies that were set up to manage the banking sector can actually impose rules and fines. And if you think about some of the articles that are in CC12 about market rigging and about PPI and mis-selling, etc., in some cases the financial sector have been seriously hit by the PPI scandal, for instance, the payment protection insurance scandal. Banks ended up paying literally billions and billions of pounds in compensation because they'd basically missold a certain product and misled the way in which consumers were. Well, actually, they weren't protected at all. It was the PPI scandal. The biggest issue was that the banks were protecting themselves, not protecting customers, in terms of people having to take out insurance to cover non-payment of any loan payment that they might have taken out with private payment protection insurance. Some of the things that they can do is also suggest reserve requirements. So again, if banks look like they're, if it's financial institutions look as though they haven't got the right balance in their reserves to cover all of the potential liabilities that they've got, then in this instance, the Bank of England and a number of the regulatory bodies can say, right, this is not right. We're going to stress test your ability to be able to meet all your expectations or meet all of your liabilities, and if you can't do that, then we'll impose reserve requirements on you and stop you from doing that, which again is likely to it should improve matters. Okay, so we mentioned the three different regulatory bodies, and again, if you need a reminder of that, go and look at those 7 videos. Don't need to look at all 7, but there are a couple, I think, specifically on the regulatory bodies and what they're set up to do and the sorts of things that they're in place to help with. Okay, you also see that on page 39, there's a little bit more detail of the regulators within the UK. It talks a little bit about stress tests as far as the Financial Policy Committee of the Bank of England is concerned, and what they would do. What does that mean? It's when they're basically looking at hypothetical scenarios to see if certain things, sometimes known as sensitivity analysis, it's almost like a what if scenario. What happens if these changes happen in the marketplace? And so what they're attempting to do is to look at a worst case scenario and say, right, have we got some sort of resilience built into the system to make sure that if these sorts of things did happen, that we're not just going to have the same sort of thing that has happened previously. Okay, so there's again quite a nice clip on stress testing within the booklet on page 39, and also some more information on the Prudential Regulation Authority, and again a nice link to a relatively simple and short video which explains that in a bit more detail. So if we then take a look at some of the things that have been put in place to try to address the issues around the financial crisis, well, one of the first things has been new structures have been brought in to monitor and regulate the financial sector, specifically in order that the sorts of things that happened during the financial crisis and in the lead up to the financial crisis simply can't happen again. The first one is the Financial Policy Committee, like we mentioned, the FPC. The second is the Prudential Regulation Authority, the PRA. And the third one is the Financial Conduct Authority, which are all regulatory bodies, a couple run by the Bank of England and a couple run by another institution. But they're designed basically to monitor and regulate the financial sector. The stress testing process I mentioned to you before, so it's quite a nice example of how this stress testing process is about keeping our financial system safe. So it's worth going and having a look at that in a bit more detail, taking a few notes on that. And in essence, what it's doing is saying, have the UK banks got the resilience and the ability to pay back any liabilities that they might have, and clearly, if the stress test suggests that there are issues as far as that's concerned, then the Bank of England or one of the regulatory authorities will be saying to a particular institution, right, this needs to get sorted, this needs to change, we need to change our reserve ratios or whatever that might be, in order that we don't get to a situation where the risk is so high and then the chance of failure, the chances of organisations failing is significantly reduced. Another thing that we've talked about previously before is this ring fencing of retail banking away from investment banking. So we've got some big clearing banks like Barclays and one or two others that have got or have in the past had both retail banking and investment banking, and quite rightly so they should. But one of the issues was that when the investment banking arms started to make some bad investment decisions, that then affected the whole of the retail banking sector as well, or that part of their business. So there's been regulations been put in place such that from 2019, the retail banking sector their retail operations have to be separate from their investment banking operations, such that should their investment banking operations cause them a problem, it's not going to mean that the whole of the retail banking sector is going to fall over as a result, to try to sort of deal with any crisis that might create. We've also got resolution. So in this case, the Bank of England might choose to either bail out the bank, or it might, in some cases, if it's in the public interest, to bail in. So in some cases, that might mean that they will take control or ownership and control of a particular bank rather than bailing them out. So giving them a loan. In some cases, it might well be that it's in the public interest to make sure we maintain or both consumer interest and public interest. But it's important that we maintain this service as it stands, and in some cases they might actually take over ownership or a controlling interest in the bank involved should that happen. There's clearly also a significant amount of extra intervention to protect consumers, particularly as far as the Financial Conduct Authority is concerned. So their main remit is about seeing where there's injustices or whether where customers might be being exploited or maybe missold, and as a result of that, there are significant things in place to try to protect consumers. Examples include payday loans, which some of you will be familiar with, where organisations are charging extremely exorbitant interest fees to people who can't afford to sort of manage their finances from 1 month to 1 month, and they clearly were, in some cases, some of them were shut down because they were clearly exploiting potentially vulnerable customers. PPI mis-selling, I mentioned to you previously, payment protection insurance, and the amount of money that banks had to pay back to consumers where they'd missold and misled them. Credit cards, obviously there are a number of credit card companies who charge at very, very high interest rates, and again, where it's not seen to be in the public interest or it's against consumers' interest, then in some cases some credit card companies have been brought to book and have had to stop charging the very high interest rates that some of them do. And then also the whole rent to own and buy to let, basically the financial nature of that business has also been considered quite closely by the Financial Conduct Authority. Okay, so if we then take a look at so that's really the different forms of regulation, and then within the last couple of pages of the CC12 booklet, there's a couple of things that I'd like you to take a look at. There's an example of an article which looks at derivatives and the complexity of the financial system, and also how the regulation of the financial system, how it might be advantageous, and also what might be some of the disadvantages and the limitations of that regulation. But in terms of a summary of that, more things that you could actually consider, I've listed some examples here. So where we're talking about advantages of regulating the financial sector, well, clearly to some degree regulations are going to stop or reduce the number of financial institutions taking excessive risks and making risky loans or buying risky assets, such as what happened within the property collapse and the financial crisis of 2007-2008. Another thing is that if banks are being forced to keep capital or liquid assets, then that is essentially some sort of safety buffer in case things go wrong. So it's making sure that they have sufficient funds available to be able to ride out any crisis, if you like. Okay. Now, the argument was that, and the reasons why the regulation of the financial sector has been significant since 2008, 2009 was basically because the lack of regulation was one of the things that caused the difficulties. Now, in this instance, clearly, because we've gone through this sort of process once before, the argument is now that if banks start to get into financial difficulty, that could lead to a loss of confidence. It could lead to contagion, where one bank becomes, effectively badly affected by another going into difficulties, and that then creates a whole issue across the whole of in this case, the banking sector. So in that situation, clearly, one of the issues is that if we're actually regulating the financial sector to a larger degree, there is an argument to say that banks might choose to then stop lending. And if they choose to do that, or they choose to make lending criteria more difficult, then there's a danger that could reduce the amount of lending to households and to small businesses, and that might mean less consumption, less investment, less AD, and less GDP. So clearly, over-regulation is not as dangerous as under regulation, but it clearly has some issues too, okay, that we need to bear in mind. If we then take a look at some of the disadvantages, then, well, in this instance, you could argue that regulators will try to get as decent a picture as possible, but there is clearly going to be some asymmetric information, because financial institutions and financial markets, generally speaking, are very complex and actually quite difficult to understand. And in some ways, some of the financial sector, you could argue, is designed to make it that way, so that we mere mortals clearly don't understand. And there's an argument to say that that could actually create a bit of an issue. But the other issue that we need to bear in mind, which is a disadvantage or a limitation of regulation, is that this principle of regulatory capture. Okay, so now one of the arguments is that some of the regulators that are put in place to protect consumers and the market from some of the issues that maybe some of the businesses that they've worked in themselves in the past have created, could be that the regulators maybe are just a little bit too close to some of the senior managers from private sector institutions. And the argument could be that that some of them that work in the private sector might then go and work at the Bank of England or the FCA, and it could be a little bit of the old boys network that we need to just bear in mind too. Okay, other limitations then. Okay, we talked about one of them already, but tough regulation can, in some cases, harm the economy. So the argument could be that if we made it too difficult for banks to work in this country, if the regulations were simply too tough, it might mean that banks might choose to relocate, and that could cause a loss of jobs and income in the UK and reduce tax revenues for the UK government. Again, there could be an argument to say that if the reserve ratios that banks are expected to hold to hold in order to make sure that they can pay their way in any scenario, could mean that they will lend less as a result. Okay, and that could obviously then reduce consumption, investment, AD, and economic growth. Okay, and for those reasons, rather than going in very hard with this sort of, clearly they've put a lot of time and effort and money into setting up these regulatory bodies, but it is very much a soft touch regulation that both UK and US governments are suggesting, so that effectively they are clearly the financial sector is being much more closely monitored than it used to be, but it's not being over-regulated, because clearly that might not be in the interest of encouraging economic growth and borrowing and loans, etc. So that's something to bear in mind too. Okay, so if we then flick onto the last page in your booklet, page 42, there are some sample questions on the financial crisis. Okay, they range from a couple of 9 markers, 1 15 marker, and a 25 marker. And again, that's just to give you a flavour of the types of question that you might get asked. Now, clearly, it wouldn't do any harm for you to have a go at planning a couple of those. At this stage, I'm not going to ask you to complete one, but should you want to do one and you want to send that in to me and I'll take a look at it, by all means do so, okay? But there are essentially 5 different questions there, or 6 different questions in fact, and some example exam questions based on specifically on central bank and monetary policy, but also in some cases, and this is quite a nice general question on page 42, essay question number 1, with reference to the information provided in your own knowledge, evaluate the likely micro and macroeconomic effects of market failure in the financial sector. Okay, so micro and macro, clearly that's that would be like a paper 3 type question, but that's when you're having to think about both the microeconomic and macroeconomic implications. So have a read of those. Obviously, if you've got any questions on any of the work that we've gone through in the last 3 or 4 presentations, please give me a shout, and we can obviously set up a meeting probably towards the end of this week where we can go through any of the issues that you've faced in CC12. But that means that CC12 is basically completed. Make sure that you've got half decent notes. I know we've asked you to do a few things where you're going and looking at a few examples and links that have been included in the presentations, but hopefully that all makes sense, and we'll catch up in the next couple of days. Okay, thanks very much for listening again.